This is TreppWire Week in Review for the week ending August 18th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, the financial markets stayed the course, and that meant more treading water for U.S. stocks and another move higher for Treasury yields. Retailers and banks were in focus, as retail sales and earnings dominated the news, and talks of higher capital requirements for banks took a bite out of bank shares. The average performance came even as earnings continued to surprise to the upside and economic data was more good than bad. Manus, is this a long overdue pause for markets that have been on fire, or is something else brewing?
Well, I think the summer of fun has gone to the bummer summer over the last 2 or 3 weeks, right? We were all feeling so great around the end of July. August started out on kind of a middling note, and it's been spiraling slowly but surely into negative territory over the last couple of days. I think that what we're facing right now is the reality that not only could the U.S. economy avoid a hard landing, I think the current narrative is that the U.S. economy is just too doggone hot right now, and that's going to keep the Fed pushing rates higher, and that in turn will weigh on stocks going forward. Certainly, the words that the Fed came out with today, or this week, I should say, via the Fed minutes, reiterated that inflation is still front and center for them. They see things as running too hot. They worry about the levels of the equity markets, the stock markets. And even before those Fed minutes came out, the positive economic data that we had been seeing over the last 5 or 6 days had really been weighing on money managers, traders, et cetera. On Wednesday, the 10-year yield hit a 15-year high. We closed the day on Wednesday at a 4.28% 10-year Treasury. That is problematic for people that are looking to purchase stocks. We now have a 2-year that is back around 5%. So in each case, these rates are now up between 25 and 50 basis points over the last month or so. While we're very happy that retail sales came in high, that U.S. GDP expectations were revised higher, that PPI, while higher, did not explode higher last week, all these things are pointing in the right direction economically, but it is reinvigorating the conversation over, is the U.S. economy going to keep the Fed raising interest rates far longer than people anticipated maybe 2 or 3 months ago?
Yeah, I think you're spot on, Manus. The Fed remarks, you lightly touched on them, but if you look at some of the Fed minutes, one of the quotes, with inflation still well above the committee's longer run goal and the labor market remaining tight, most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. That was from the meeting summary. We haven't seen any type of slowdown on employment. Unemployment has still stayed remarkably low. ADP job numbers considerably higher. Retail sales came in above expectations, putting the Fed in a really tough spot here. So it'll be interesting to see how they continue to progress over the next couple of meetings, if they take another pause on this upcoming meeting, or if they decide to go another 25 basis points. I did see this week 30-year fixed rate mortgages in several states averaged above 8%. So we basically gone from a 3% 30-year fixed rate mortgage to 8% in the period of about 18 months. And prices are still going up due to a lack of supply, because there's not anybody putting their house on the market when they're locked in at 4% interest. All of these things put together make for a very interesting dynamic marketplace. I wanted to give some additional color on a few of the things you mentioned. PPI, so the U.S. Producer Price Index was up 0.3% in July. That was according to Labor Department on Friday, was up from a revised reading in June. And this 0.3% is the largest gain since January. Retail sales increased 0.7% in July. They were up better than expected, as consumer spending is still holding up. So again, narrative showcasing people's activity with a really hot economy, people still spending. If you look at retail earnings, Target stock was up 9% as they had a really big profit, which offset revenue misses and lower guidance. So they were up about 9%. TJ Maxx, they run TJ Maxx, Marshalls, and Home Goods. They had year-over-year sales and profit growth thanks to strong consumer traffic. So, some cash-strapped buyers are really pulling back on discretionary purchases, but spending at TJ Maxx. Home Depot earnings, they were a beat on earnings on the estimates, but their sales were still down and consumers continue to pull back on big ticket buys. Their stock had initial pullback after the announcement, but then recovered fairly quickly. So I think mixed greens there on the retail earnings. And I agree with you. I think all eyes will be on the Fed as they have been. And there's a little bit of mixed signals. You mix in August and a lot of people on vacation, holiday. And, this has kind of been an enigma of a month relative to what we were feeling at the end of July.
Yeah, I would say that we're running at about 70-30 good news over bad news. Those earnings that you referred to a moment ago, certainly no disasters among the retailers that we've seen thus far. Most have done better than expected, as did most companies over this most recent earnings cycle. As I said, GDP was up, revised upwards. The retail sales number that you referred to came in better than expectations. All those were positive. If there were a couple of nicks in the market this week, I guess you'd point to two or three different things. The first would be with the regional banks. We saw one headline from CNBC that Fitch was perhaps on the verge of cutting ratings of several big regional banks. We did see the Minneapolis Fed president come out and say that higher capital requirements were going to be necessary for banks above $100 billion. That news, both of which came out the same day, took a big bite out of bank shares, but those are more future events. Those are not indications of what's happening on the ground right now with regard to the economy. We did see home builder sentiment come in quite negative today, and that's not really surprising when you talk about rates with an 8 handle, like you were referring to before, or a high 7 handle. And then the other wild card, which I'm very much a tourist in, I mentioned this to Lonnie and Haley before, we see a lot of headlines out of China that the Chinese economy is struggling, that sentiment there is negative. The Chinese currency is at a multi-month low against the US dollar. Periodically you'll see foreign currencies have issues that bleed into US sentiment and the US economy. Whether this does or doesn't become an issue that raises more volatility in the US market, I think remains to be seen. And as I said, I'm really a tourist in that, but those would be the three things that caught my attention on the downside this week.
Yeah, I think just add a little bit of color on the capital requirements for banks. That was part of a joint proposal. The top 3 U.S. bank regulators put together about 1,000-page overhaul. Effectively, the net result would be an additional 16% capital requirement for banks. So that's sizable. Obviously, that would send some pretty significant waves through the sector. One of the interesting stories, you mentioned the China market. There was actually several comments around Country Garden Holdings, a large firm in China that suspended some bond trading, said they were formerly the largest developer in China by sales. They effectively missed international bond payments last week and basically said the culmination of a 2-year liquidity crisis across the real estate sector was starting to escalate. So again, I don't really have a lot of knowledge or depth there, Manus, but if that continues, or if that has some contagion to some other players in that market, you could definitely see it's, finding its way over into the U.S. markets as well.
Lonnie, I think maybe we should send you overseas. We should send you to the Far East with maybe one of those English-Chinese dictionaries, and you can find out what's happening on the ground over there. I'd love to know more. We've seen these scares before about the real estate market and real estate developers there missing payments and so forth, and property owners there either struggling or getting upset, lobbying the government for solutions and so forth. But I am so out of my, I stay in the shallow end when it comes to currency issues and foreign exchange flow of funds and so forth. So we may have to put you on a plane to Beijing with one of those dictionaries and have you really kind of investigate what's really happening there. I'm going to pivot for a second and take the macro back down to the commercial real estate and try to tie it into what's happening with the banks at this potentially higher capital requirement level. And this is not necessarily my own idea. I was trading an email yesterday with a gentleman that was talking about CREs in the broader context. He is very bearish. I'm not nearly as bearish as he is. And by the way, to that listener, I will reply to your most recent email shortly. He put out this thesis, and I had to agree with it, that CRE is a little bit of an island right now. Everything is doing really well. The U.S. economy, full steam ahead, even though interest rates are higher. Residential, property values have held up. Unemployment stays low. The U.S. economy is ticking. And his point was commercial real estate is not ticking. And unlike 2008, when we were all in the same boat and everybody was failing at the same time, CRE is a little bit of an island right now in that it's the outlier. It's the thing that either is subperforming or people expect to get worse. And his point was, in an economy that's growing, there's going to be no appetite to help out commercial real estate developers in an illiquid market. And that's what we're seeing right now, right? 3 of the 4 traditional lending sources, CMBS, banks, non-banks, are constrained right now. Insurance companies are not constrained. So that means there's less capital available for CRE. And if you raise the capital requirement levels, that liquidity becomes even tighter. And as interest rates go up, the velocity of money gets even slower. And I have to agree with that this higher capital requirements for banks could kind of kick the CRE market when it's starting to be down. And it'll be interesting to see how that plays out.
Yeah, I mean, I think the banks obviously are going to push back as hard as they can on any additional capital requirements. I was actually on a bank panel in Orlando yesterday, and so there were 2 president CEOs of banks and then one of a credit union, and just some interesting insight from them. They said construction lending broadly was very, very difficult to come by, that they were really not doing any construction loans unless there was super strong sponsorship, upfront deposits to help offset loans, and you would get approved for up to a certain amount, and then if you hit certain leasing or other things, then they would release some of the upfront funding that they required and extend the loan to a larger amount. So construction was really constrained. The sentiment that you just expressed, which is lack of liquidity, they were all on board with that as well. And with all the negative thoughts that they had around construction, though, it was pretty interesting. They were fairly optimistic about the other property sectors outside of office. So if you were not doing an office loan, obviously these were banks that require personal guarantees, and sponsorship is certainly very important. They made that a point of emphasis. They said they were down about 20% year over year in terms of their commercial real estate lending. And so it was, for me, probably glass half full in that regard, that they're basically at about 80% of what they were last year. Given what I know about the CMBS issuance, I would call that a win. So it was kind of interesting to hear their perspective. They also said, the 3 of them, none of them have taken any properties back. And in fact, none of them, as of yesterday at the panel, said that they had any properties that were greater than 30 days behind on the mortgage. So they felt like their loans, and they were mostly in the Florida market, were actually doing really well, and they were standing by their underwriting on those properties. I understand exactly what you're saying with the lack of liquidity, and the reserves would make that even more so. But it seems like from some folks yesterday, in a pretty hot market in Florida, while they were not totally optimistic, it wasn't completely doom and gloom either from boots on the ground.
I've mentioned this before that, we get an awful lot of emails coming in this week. Sometimes it's questions for us, and sometimes it's just opinions or asking our thoughts on various things, and they're wonderful back and forth. And I've mentioned that for those that take a position, I always find most weeks it's 50-50. 50% of the audience that does take a position says we're not bearish enough, and others will say we're way too bearish, right? Things are not as bad as we are sometimes giving off. And to me, that seems like a good place to be. It means that we're kind of giving a fair assessment of what's going on. But for what it's worth, this week, it was really hard to find anybody. In fact, I can't remember anybody telling me things are great. Of the 15 or 20 or 25 people that I spoke to, traded emails with, Zoomed with, the sentiment was almost unanimous, or maybe it was unanimous, in that, survive to 25 is the mantra right now, that we are dealing with a lot of distress, which is contrary to what you heard this week, Lonnie. People were confident there. So maybe it's just the timing. Maybe it was, a couple of guys got too much sun and, were dehydrated or fighting a bad sunburn. It was a bad week. But that certainly was the case for just, the week ending August 19th.
So let's jump into our office stories this week. We have a few new categories.
All right. Like Haley said, we have a lot of diverse stories. They don't really fit into necessarily one category, but we'll go through them. Coming off my negative sentiment remarks, I'll start off with just an enormous green shoot for the New York City market. We sent this out on Tuesday afternoon as a Trepp flash the minute we saw it being reported, and then we saw it get picked up by 15 or 20 different news outlets. It was so impactful. The people we think that broke it were Real Estate Weekly. We'll give them the credit for that because I think they were the first ones out with this. RXR in New York extended the lease of law firm Davis Polk at 450 Lexington Avenue. This is noteworthy on several levels. Level number one is the length of the lease, 25 years. You rarely see something for that long, a time period. The sheer size of this, Davis Polk had almost 700,000 square feet before the renewal, it's the biggest square footage I could think of for any law firm in New York. They are not shrinking. In fact, they are adding another 30,000 square feet, which will push their total square footage over 700,000 square feet. Talk about a big vote of confidence for the New York City market. I loved being able to send that one out on Tuesday.
Yeah, it's really great to see, and especially given that they're adding on additional space. They did talk about the building undergoing a $300 million renovation, going to upgrade some of the common areas across Davis Polk's 23 floors. So really great news there, and I think a great one to kick off on the office sector this week.
For those that don't know in New York, that Lexington Avenue, 3rd Avenue corridor, in addition to everything else we just said on that lease, it's not a particularly loved area. It's not Hudson Yards. It's not new. It's not One Vanderbilt. And so you could add another level of admiration for this particular news, or happiness over this news, that this comes in a part of the Midtown market, which, has seen more losses than gains over the last 10 years or so. So another reason to really love this story. Moving on to some of the other stories we have here. This is a coming to market story. Comes from Caitlin Anderson of Minneapolis St. Paul Business Journal. The owners of the Capella Tower, which is in downtown Minneapolis, have put the building out for sale. Shorenstein Properties is the owner. It's the second tallest office building in Minnesota. Ms. Anderson says that the skyscraper could sell for $200 million. If Shorenstein is able to get a price like that, it would be a 20% discount to the $255 million they paid for the property in 2018. So a potential comp there coming. And actually, I think that's somewhat of a green shoot. If Shorenstein gets $200 million for that property, Minneapolis has been hard hit. A mere 20% discount from 2018 sounds like a win. And when you compare the next two stories that I'm going to talk about, you'll see why. A couple of discount sales. This first one comes from Dan Brendel of the Washington Business Journal. Berman Enterprises has acquired Tyson's Concourse, which is a 2-building complex totaling 350,000 square feet in Vienna, Virginia. Berman bought the property from a partnership between Atlantic Realty and Angelo Gordon for $20 million. The sale closed last month, but was only reported this month. This is a very disappointing comp. The property sold for 75% less than what the seller bought it for in 2016. This property traded for $78 million that year. So real disappointing comp there. In San Francisco, 60 Spear Street. This comes from the San Francisco Gate. That property sold for $40.9 million. This is down from $107 million in 2014 when Clarion acquired the property. The property once had a Walgreens. It was one of the 10 that closed in that city last year. The new sale price of $40 million equates to $260 a square foot. The buyer, Presidio Bay, is looking to reposition the asset into Class A and to upsize the property slightly. So What are my takeaways from this, Lonnie? And it'll be great to hear your response. For me, in the Minnesota, I've already said that would not be a terrible outcome, the 200 million. These other two sales, while terribly disappointing in the prices that they cleared at, we're starting to see the formation in some markets of a bottom, right? The fact that Presidio Bay is willing to come in and pump some money into this is an indication that they think they're going to get value out of this on the back end. We talked about a week or two ago, Fisherman's Wharf, which is a mostly vacant property in San Francisco that was going to be redeveloped. There was the B of A Tower in San Francisco that traded at a big discount. To me, this is what a bottom forming event looks like. And I think most cities are very far away from finding a bottom. But here in San Francisco, you're seeing enough happening there that the markets are starting to find that level. And maybe you say the same thing now in Baltimore and Washington, D.C. We've seen enough deep discounts in those two markets that maybe one is starting to form there as well.
Yeah, I would agree with you. $260 a square foot in San Francisco on Spear Street would have been unheard of. The fact that we now have a couple of sales in that market that kind of mark this 200, 260 per square foot price, I would agree, probably signals, a bottom there. I still think in some instances, you're probably going to have buildings that maybe are in lesser desirable locations long-term where they may actually sell for less. But to your point, you at least have the ability to formulate, the type of discount you're looking at in that market. Whereas 6 months ago, it would have been complete speculation. The Minneapolis story, agree with you there as well. We've had so much negative office news coming out of that market. If they could get anything for 200 million, I think everyone calls that a win. Even if you're the seller that loses 20 million bucks on that deal, probably having a celebratory dinner when you sell that one. The Berman Enterprises, interesting on that one, that it just, if you look at the sales price there, it's almost so low that as the buyer, you still feel like you probably overpaid. So, that one traded for 78 million and 16, and you're buying it for 20. You probably are still a little unsure if that's enough of a discount. I mean, it's so far off the beaten path in terms of other sales there that you hope you're getting it for what you need. So I guess the one silver lining, if we're looking for some silver lining here, is just that we've talked about this on the podcast. The markets really struggle when there's uncertainty. The markets can do okay. There's a resetting of basis. Some people lose money, but it creates opportunity for the new buyer to come in. And it feels like, I agree with you, that we're, even if we're not at the bottom, we're at least getting a lot more certainty around what the discounts are going to be for those to trade. So hopefully this is a short cycle, and we can start seeing these deals across New York, DC, Chicago, and other markets, and we can get to that bottom quickly so that things can turn back around and come back to the upside.
Yeah, I think your point is a good one. The formation of a bottom is not necessarily a negative. It gives people the ability to move ahead confidently. If you are a lender and you know that things can be sold for $260 a square foot, it removes the uncertainty. When nothing is selling, nobody is lending because they really can't put a firm thumb on the scale and say, here's what the price is, right? I'm not sure that's the proper metaphor, but they can't really circle a number and say, we can say with confidence, this property is 40 million. So when you see it in the stock markets, when you see the formation of a bottom, that's usually followed by a nice rally, a rebound. You start seeing equity prices grow again. And when it happens in real estate, the same is true. The downside to this is, I think, that some markets, it will come quickly, those that have been the hardest hit, like San Francisco, and some may take a year, 2 years, or 3 years to take place, right? I think every market will move along at its own pace. And sadly, I do think that in some areas we'll still be talking about this in 2025, but time will tell. And I thought these were two interesting stories. Moving on to some other things that we saw this week, a little bit of a potpourri. This was a positive story. I hope I pronounced the name right. This comes from Liez Klein of CT Insider. Pondview Corporate Center in Connecticut sold for almost $30 million. This is a Class A space on Batterson Road in Farmington. The property is 92% leased. It's called the largest sale so far in 2023, according to CBRE broker Jeffrey Dunn. I like the story because it's more evidence that The velocity of money, the level of transactions we're seeing is not zero. Sometimes office sales are getting done, and this one in Farmington for $30 million is another example of that. A couple of moving on stories. This first one comes from Luther Termel and Alexander Soleil of the Darien Times. Frontier Communications is looking to move its official headquarters out of Norwalk, Connecticut. They are looking primarily at Dallas as the likely option for their new headquarters, although Tampa is said to still be in consideration. So there could be a major company leaving that Norwalk area in the near future. In the Kansas City Business Journal, Thomas Freisted says that Blue Cross and Blue Shield of KC has put its current headquarters up for sale. That property is at 2301 Main in Kansas City. So a couple of things happening in the moving on. And then in a, normally we say brokers start your engines. Maybe it's more appropriate to say brokers start putting gas in your car to be ready, because this is a little bit of a future. But Laura Waxman of the San Francisco Business Times, who we seem to refer to every week, is reporting that Snowflake is surveying various options in Silicon Valley for new office space. Snowflake currently has 200,000 square feet in San Mateo. It's said to be on the hunt for something bigger. So they want to move up from 200,000 square feet. The company's requirement will not kick in for another couple months, and that's why I say put the gas in your car, not necessarily fire up the engine just yet.
Yeah, Laura Waxman, she's like a regular. I think it's like almost every week, if not at least every other week, that she's mentioned here on the pod. So keep up the good work. She had another story this week talking about the new high-rise office that was slated to start there in San Francisco, having the brakes put on it. So they've decided to hold off on commencing that project. So a lot of good content coming from her on a daily basis, and we get to cover that here on the podcast. So it's interesting on the Frontier story, Manus, it actually said that the reason they're considering Dallas, one of the reasons they're considering Dallas, is the CEO actually lives in Dallas. So that's some pretty big shoes if you can say, hey, we're going to move our corporate headquarters, make it a little more convenient for me to get to the office. But they did ask for some special designations. They've asked for an enterprise zone for their corporate office there, which will probably lead to some tax abatements or some other incentives from the city of Dallas to try to lure them there. So I think that's actually set for a city council meeting coming up here at the end of the month. So that probably weighs fairly heavily in the decision on if they're going to choose, Dallas, or maybe look at Tampa or some of the other options that you mentioned.
Well, Frontier is probably looking in that discount bin a little bit because of that story last month that we mentioned about the firm, along with AT&T and Verizon, having exposure to lead wiring in the ground. Their stock sold off big time last month, as did the other two over this. So I don't think paying $300 a square foot for one Vanderbilt in New York is any longer in the Frontier budget, if it was ever in there. I'll run quickly through the sublease stories from this week. There were several of them in Houston. NOV Inc., which is one of Houston's largest public companies, has put its former headquarters up for sublease. This is going to be a big swath of space coming to market, 340,000 square feet. It's known as the Parkwood campus. And by the way, this story comes from Jeff Jeffrey of the Houston Business Journal. They have moved on from this property a long time ago. It's an interesting story. The property itself backs about $40 million in CMBS debt. It will now be vacant until it gets subleased. So in most cases, you would say that's a really worrisome CMBS loan. However, in this case, NOV has a lease that is unterminable until 2037, so no risk there. And when it was underwritten, the appraiser said that NOV is locked in at $10 a square foot for the life of the lease, and the market at the time in 2019 was about $15 a square foot. So they're about 35% under market in what they're paying. And I guess that gave the lenders substantial comfort in making that loan. Elsewhere, a couple of other things. Molo Solutions has put 47,000 square feet of sublease space out on North Green Street in Chicago. They just signed that lease 2 years ago. The lease runs through 2034. That comes from Cranes. From BizNow in Dallas, Home Point Financial has put 65,000 square feet of space up for sublease on Luna Road in Las Colinas. And in Ohio, Constellation Insurance has put 1/3 of its space up in its greater Cincinnati headquarters up for sublease. Lastly, I have to give Lauren, I'm going to butcher this name, Onisarge, a real shout out this week. She did yeoman's work on covering the amount of sublease space in the Triangle region of Raleigh-Durham in North Carolina. She works for the publication called Triangle Inno, which I assume means innovation. Their Policy Genius, 50,000 square feet, SAS in Cary, Insight Software, 64,000 square feet, and SoftPro, 22,000 square feet, all coming up for sublease in Cary, Durham, or Raleigh. So lots of sublease stories this week.
So let's talk about some multifamily stories.
So we haven't talked about multifamily a whole lot in recent weeks, but we did have a couple of, I would call them bona fide green shoots. I know that we've had some negative stories, some crabgrass recently about the syndicators and not a lot of green shoots, but here are a couple. Jeff Andrews and Rich Bachman of The Real Deal reported that Pacific Urban acquired a Chelsea, New York City multifamily property for $185 million. This property is at 130 West 15th Street. It's a 213-unit luxury tower, and the sale equates to a price of about $870K. The thing that really caught my attention here is that the article notes that the sale was done at a 4% cap rate, which is really unheard of in this market, as Oz, a longtime listener and one-time guest, usually points out that a cap rate is only as good as the NOI projections you put into it. And that's certainly true. And we don't know what kind of loan growth was put into that 4% cap rate calculation. But anytime you see a 4% cap rate in a market that feels like a 6 or 6.5% cap rate environment, that's attention getting.
Yeah, I would agree with you. I just pulled up quickly some data in our system. If you look at the nationwide trailing 12-month cap rate for these high-rise types of assets, they're actually sub 4% on the trailing 12-month. So, it's probably not too far outside of what we're seeing in the marketplace in terms of new issuance and the going-in cap rates on those deals. So, kind of crazy to hear me say that given what I know about interest rates right now. But that's what the data is telling us. So again, cap rates, point in time analysis, don't know the inputs, don't know the outputs, other than just sales price and NOI. Not really a great metric, in my opinion, unless you have the full detail.
And New York, as we know, they saw record-breaking rents for market level product last month. I think you reported that, Lonnie, and that certainly will go a long way to building confidence and supporting a low cap rate when you see that kind of record-breaking north of $5,000 a month average rent that we noted last week. Another positive story here, Jackson Chen of Multi-Housing News reports that Harbor Group International has disposed of 6 properties in the Boston suburbs for $460 million. This totals about 1,700 units, and the portfolio was owned for about 4 years. HGI acquired the assets from Lone Star Funds in 2019 for $380 million. So about an $80 million, close to 25% return for HGI over 4 years, which a green shoot on several levels. The size of the transaction, the step up in the 25% appreciation, and getting a 9-figure deal done in a illiquid market. All of those things are reasons for calling that a green shoot. And then lastly, I'll point our listeners out to this. I thought this was an interesting story. There was a Wall Street Journal opinion piece written this week. I don't think the editors wrote it. I think it was a guest written piece. The title was "Rent Control is Constitutionally Vulnerable." And this article starts by saying a New York 2019 law is so onerous that the Supreme Court may revisit the issue for the first time in years. The issue there is that the Supreme Court years ago said rent control, I think it was in the 60s, is okay. But at some point, if it becomes so onerous that it becomes a taking, then those in government must compensate owners of properties for making the law so onerous. The writer of this particular piece, which is worth a read, points out that we are at that level and this may get the Supreme Court review.
So let's close out the property type segment with some retail stories.
The first one, Lydia Dinkova of The Real Deal, is reporting that Edens has acquired the Shadowwood Square shopping plaza outside of Boca Raton. They're paying $88 million for that retail property. The property itself, 260,000 square feet on Glades Road, 70% occupied, anchored by a Sprouts Farmers Market. The article notes that it's one of the few South Florida big retail property sales done this year, that the market has been weighed down by the expensive interest rate and loan costs that we referred to earlier. And just moments ago, we saw a story that Aldi will be acquiring Winn-Dixie and Harvey grocery store chains in a consolidation of the grocery store marketplace. I guess maybe that has to go through some kind of antitrust oversight. I'm not sure, but that's some activity there. And I wanted to close, Lonnie, I wanted to give you some of these data points, not just for you, but for our listeners as well. I had to do a presentation this week for a group of about 80 originators, and it was a pleasant back and forth with several people I had never spent a lot of time with. But in pulling together some data, I wanted to put together some information on recently originated loans. We talk a lot about the velocity of money, deals getting done. Some people come back to me and say, I'm Pollyanna, there aren't deals getting done. And other people say, we're spot on. It's a mixed bag. But I wanted to give people some indications that some really unloved parts of the market are getting financed. So I'm going to start with the malls since we're in the retail segment. Here are 4 examples of loans that have been securitized recently and where they came in. Fashion Valley Mall in San Diego, 5.73% interest rate based on a 32 LTV and a 3.15x DSCR. So that's a comp for people that are looking for where deals are getting done. The other loans that I'm going to talk about, higher leverage, 32 obviously is really low leverage, higher leverage, but with it came higher rates. Brandon Mall in Brandon, Florida, 7.62% rate based on a 55 LTV and a 233X. Cumberland Mall in Atlanta, which is near where the Braves play, that really rapidly going Battery area, a 787 rate based on a 49 LTV and a 166X DSCR. And the Oxmoor Mall in Louisville, Kentucky, 8.12% rate, 59 LTV, 1.50X. I want to give some office comps too, but Lonnie, let you weigh in on, what you're seeing with the malls. I know that your team has built some product views which reveal some of this data. What are your thoughts on this?
Yeah, I think it's surprising when you throw out some of those rates that they were able to lock in. I think what maybe allowed for some of those deals to get done was just the really low leverage points. The question I would have is on the valuation side, really, for these malls. I mean, if they're looking at just in-place leases and getting to an NOI and anticipating that that's going to persist over the hold period, potentially. But I think what we've seen with a lot of these malls is that NOI is not that secure. If tenants vacate or don't renew, you're not backfilling those spaces. And so I definitely think there should be some additional credit loss calculations or, vacancy compared to other market or other assets in the market. And potentially the appraisers did that, but that seems really low leverage, but I think that's what's required to get a mall deal done today. But to your point, it still proves that there's an appetite at some level and at some price for these deals. And so, it might be that the lender just doesn't want to take them back. There's always that on the mall side too, is that, if the lender can extend something or do some new origination on a deal, at a really low leverage point, it might make sense for them to do that, on a relative basis.
Yeah, the interesting thing here is all those data points were from new CMBS, and every new CMBS, I don't know, it must get 50 or 100 or maybe 200 separate eyeballs on it from potential buyers of these assets. So you really run through the gamut of people looking at this and having to be comfortable with the type of financing you've set up. And I think that, this is a response to those that say there's no capital available. There is some capital available. It's not zero. There's deals getting done. Very quickly, I'll go through the office comps that we saw here. 1 and 2 Commerce Square in Philly, 7.79% rate. That's based on a 51 LTV and a 168 DSCR. 1825 K Street in DC, 755 rate. That's on a 53 LTV and a 174X DSCR. And a Back Bay office in Boston, a 630 rate, super low LTV of 34 and a DSCR of 255. So hopefully you enjoyed hearing that data. If you'd like to hear more of that, we'll make this a recurring part of our TreppWire segment and talk about where money is getting done. Of course, a lot of those rates, Lonnie, were probably locked in 2 or 3 months ago when rates are 25 to 50 basis points lower. So probably those 7.5s become 8s, 8s become 8.5s, right? Take those with a grain of salt for those that are looking to use these against your loan originator broker in trying to get that maybe 6 handle when maybe a 7 is more appropriate now.
Yeah, and I think this week our friend Jeff F., that's a loyal pod listener and active on Twitter, he's been, posting some pretty interesting takes on the 10-year and what's happening with rates and how constrained the market is. I know he's in that business of helping people secure financing. So I think those are great data points. And as you mentioned, Manus, our products make it super easy for people to get access to that type of data in real time across any of the income producing asset classes in the U.S.
This week, we have 2 programming notes. Both are invites to 2 upcoming webinars. The first is our next Trepp targeted training, which is a client-only webinar on Tuesday, August 29th at 3 p.m. Eastern. We're hosting a training that will dive into the hidden distress in floating rate debt. So we'll show clients how, as more of these loans come due for a rate reset, they will be facing significant payment stress, and you can find these loans in our platform. So if you're a client, please email your account manager for access or send an email to podcast@trepp.com. And on Thursday, August 31st at 3:30 Eastern, Lonnie and our other co-host, Stephen Bushbaum, will host our next Market Pulse webinar. We'll cover topics such as the bank downgrades. We'll give a glass half full or glass half empty look at the office market. And we'll have a Labor Day special, which will talk about student housing and big box retail. So send us an email for that link as well. That is open to anyone in the industry. And turning to shout outs, Zach K said it's been extremely helpful to stay up to date on transactions in cities that he otherwise would not pay attention to. Marty K is a commercial lender with a bank. He said they're big fans of student housing there and have been for a while, and they actually have more outstanding credit committed on student housing than they do office. Callie G gave us a shout out in the CREFC newsletter as her favorite podcast. And Pramod B came back to us. He had some questions about the exposure to commercial properties in Maui after the wildfires. So our research team actually put together an exposure list. Clients, you can access that on the Loans in the Spotlight page.
We did talk about this last week, Lonnie, with, Maui and the forest fires and so forth, talking about the insurance angle, how historically disasters like this have been covered by insurance. But the listener and the commentator who checked in with us pointed out that so much of Hawaii is built on tourism. And if this wipes out tourism, that's the kind of thing that doesn't necessarily get covered with insurance with business interruption risk. And there may be a different level of concern here that you might see in Hawaii for real estate than you might have seen elsewhere. So that's a good point, and we could peel back that onion a little bit more next week.
Todd S. said he loves what we do. He had some comments on Manus's student housing anecdotal stories about Clemson last week, and I know, Manus, you got back to him. Wendy P. thanked us for her shout out last week, and I know a few of our listeners actually reached out to her after we mentioned her name, so thanks for that. Alex N. and his editor liked Manus's alternate idea for the American Dream Mall. they felt the name was extremely fitting for the proposed purpose. Akiko M is a loyal listener and was interested in our WeWork data. Brad W said, "You guys are fun to listen to and informative." Mark S on Twitter gave us a shout out. He said, "We have the data and the analysis all in one podcast." So thank you, Mark. He's a very loyal listener. And Alex H on Twitter loved the student housing talk. He said, "Today's rents are a far cry from the $150 a month he paid to share a 2-bedroom apartment." And then David C, Jen R, and Taylor H also reached out requesting some of the data from our last podcast.
And I was going to throw a few shout outs in here at the end, Haley. As I mentioned, I was down in Orlando at a Florida Realtor and CCIM event yesterday and was able to speak on a panel and got to run into a couple of friends down there. So I wanted to give a shout out to Nicholas M, who's a longtime listener of the pod and fan of Trepp, and Jennifer F, very similar. She actually, when I spoke with her yesterday, said she listened to last week's pod episode while she was driving up to the event yesterday. And she had some really good questions on some of the content that we covered. So great to see them in person. And then got to meet a new friend from Twitter this last week. Kyle H had reached out and inquired about some information on Trepp. And so I reached out to him on Twitter and we were able to set up a call. And so great to meet some people that listen. And I appreciate you guys giving us some time every week when we put these out.
And I'll throw one out there to Scott L, who arranged the get-together earlier this week with the originators across the U.S. And he's a Saturday morning listener, and we are grateful for his listenership.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.